Edward Lee is Regional Head of Asian Rate Strategy at Standard Chartered Bank in Singapore. Edward, thank you very much indeed for joining us. First of all, it's a difficult place for the central bank there in Thailand. On the one hand, they need to combat rising inflation, and because they've cut the growth forecast, they need to do something in the longer term to stimulate growth. So what do?
I think for the meantime, what they'll do is to continue to leave rates where they are. I think you're absolutely right. I mean, the floods would possibly cause a spike in inflation. For this month, we expect a 0.5% month-on-month rise, translating to a 4.5% year-on-year rise. But I think it's very clear that this inflation reading should not provide too much of an info to how the Bank of Thailand will conduct its monetary policy, given it's only a short-term phenomenon. Also, very importantly, we will have the reconstruction efforts, which will come back next year, clearly. Of course, the direct spending and earlier announced stimulus measures, which will help to boost growth in 2012. So at the moment, it's still a bit early for the Bank of Thailand to say, for example, cut rates, and clearly they should not respond to this higher inflation print.
Okay, so you're saying they're going to be on hold, but for how long do they remain on hold? Because there's going to be a stage when, you need to get the reconstruction and give it some momentum as well.
Correct. Well, for our case, we think that they'll be on hold for some time, actually, through next year as well. As you noted, the reconstruction next year will help on the growth, and that in effect will help to push through some inflation. But at the same time, global events clearly do not look very good. Currently, what we are seeing is things are muddling through, and the global economy is clearly quite prone to any negative shocks. So it's still a very balanced situation, and that's why we think currently they do not have to do anything for the moment.
Okay, talk to me about Indonesia here as well, a different set of things to actually look to here as far as it goes. We've got some base effect normalization here after the holy month of Ramadan came to an end in August.
Sure. The food prices easing after Ramadan will help there, and clearly Indonesia's decision in terms of central bank has been quite different to Bank of Thailand and I guess the region as well. I mean, they've already cut rates once, and it helps that for them inflation is well within their inflation target zone. Now, with inflation expected to go down to 4% year-on-year, we do expect them to continue to cut rates over the next two meetings. That's to say, for the BI rate to 4 to 6% from the current 6.5%.
Edward, okay, so the next move by both these central banks is going to be, I guess, a cut, but we don't know when exactly it's going to happen. Tell me something, is that what's really been responsible for the way that we've seen these two countries' bond yields fall back quite as much as they have?
I think in terms of the bond yields, it's more in terms of fundamentals. For one thing, yes, domestic investors have been a bit short, as the earlier part of the year, it's been mainly foreign investors have been buying. So with the turn in economic fortune, the domestic have been buying, as in September, the foreigners sold heavily amid the global risk aversion. But at the same time, with risk sentiment seemingly a lot more stable, we have seen some resumption of buying, while at the same time, as I noted earlier, the economic conditions have turned. That's why the domestic players are also buying. So in a way, in part it's due to the monetary policy, but I think more broadly it's due to the fundamentals changing.
Edward Lee, thanks a lot for that. Edward Lee's at Standard Chartered Bank there in Singapore.